United States Treasury securities are government debt instruments issued by the United States Department of the Treasury to finance the national debt of the United States. Treasury securities are often referred to simply as treasuries. Since 2012, the management of government debt has been arranged by the Bureau of the Fiscal Service, succeeding the Bureau of the Public Debt. There are four types of marketable Treasury securities: Treasury bills, Treasury notes, Treasury bonds, and Treasury inflation-protected securities, TIPS. There are also several types of non-marketable Treasury securities, including State and Local Government Series, SLGS, Government Account Series debt issued to government-managed trust funds, and savings bonds. All of the marketable Treasury securities are very liquid and are heavily traded on the secondary market. The non-marketable securities, such as savings bonds, are issued to subscribers and cannot be transferred through market sales. Backing of U.S. currency: Federal Reserve banks are required to hold collateral equal in value to the Federal Reserve notes that the Federal Reserve Banks puts into circulation. This collateral is chiefly held in the form of U.S. Treasury debt, federal agency, and government-sponsored enterprise securities. History: to finance the costs of World War I, the U.S. government increased income taxes, see the War Revenue Act of 1917, and government debt, called war bonds. Traditionally, the government borrowed from other countries, but there were no other countries from which to borrow in 1917. The Treasury raised funding throughout the war by selling $21.5 billion in Liberty bonds. These bonds were sold at subscription, where officials created coupon price and then sold it at par value. At this price, subscriptions could be filled in as little as one day, but usually remained open for several weeks, depending on demand for the bond. After the war, the Liberty bonds were reaching maturity, but the Treasury was unable to pay each down fully with only limited budget surpluses. The resolution to this problem was to refinance the debt with variable short and medium-term maturities. Again, the Treasury issued debt through fixed-price subscription, where both the coupon and the price of the debt were dictated by the Treasury. The problems with debt issuance became apparent in the late 1920s. The system suffered from chronic oversubscription, where interest rates were so attractive that there were more purchasers of debt than supplied by the government. This indicated that the government was paying too much for debt. As government debt was undervalued, debt purchasers could buy from the government and immediately sell to another market participant in a higher price. In 1929, the U.S. Treasury shifted from the fixed-price subscription system to a system of auctioning, where Treasury bills would be sold to the highest bidder. Securities were then issued on a pro rata system, where securities would be allocated to the highest bidder until their demand was full. If more treasuries were supplied by the government, they would then be allocated to the next highest bidder. This system allowed the market, rather than the government, to set the price. On December 10, 1929, the Treasury issued its first auction. The result was the issuing of $224 million 3-month bills. The highest bid was at 99.310, with the lowest bid accepted at 99.152.